All right, we are back. Another episode of, you guessed it, the I Love Annuities Podcast. This is Jeremiah Conger, along with Zachary Van Ness, and we are boom, 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 the Annuity Dudes. And we're excited to bring a new episode to you with some really relevant content around the markets and all of the volatility that we've been experiencing. And right now, there's a lot of people that are having regret and concerns about their retirement portfolio due to how much maybe unnecessary risk they had inside that portfolio. And now some unexpected market turmoil has occurred, and we're starting to have some regret about maybe we should have pulled back or not been as aggressive in the markets. And it's been unreal. Just in the last few weeks, significant amounts of savings and retirement accounts have been wiped out from the U.S. stock market. Just a poll the other day, I think it was 2 days ago, stated that approximately $4 trillion with a T, $4 trillion has been lost in these recent volatile events in the stock market. So with that being said, I think this is an appropriate episode to help people understand that there are better ways to safely grow your money. There are better ways to give you peace of mind, to ultimately still earn fair rates of return, but do so without taking unnecessary risk. And in this episode, we're going to be discussing previous black swan events and different periods in time where the markets have done what they tend to do, and that is go down. I know that it's very easy to get caught up in recency bias when, the markets have been up for the last, 12, 13 years now. But what goes up must come down. And as everyone knows, markets are cyclical. So they look like a tide chart. They ebb and flow up and down according to different events in the world. So with that being said, later on in this episode, we're going to be discussing vehicles that you can consider to help you get fair rates of return without taking unnecessary risk. And we're actually going to give you an example of and show you a real life chart of what this product can do for you and what it would have done for you if you owned it in the past. So, Zach, how's it going out there, man?
Doing good, man. It's funny. Well, not funny, but interesting. I'm starting to see more of that concern in the clients that we're meeting with in the past week. And a lot of that fear is setting in and how this is affecting somebody who's looking to retire, whether it's short term or in the next 6, 7, 8 years.
Yeah, I think the biggest thing with this, when these events happen and we see this significant turbulence and a downward momentum, I think it's important to know that when these crashes or when these corrections or whatever you want to call them happen, that it does take time to rebound. It takes time to get that money back. What I will tell you, though, is that never should anybody be making reactive decisions on what to do with their retirement account. We want to be proactive. We want to make sure that we're taking a proactive approach. And in order to do that, it all comes down to the proper planning. We need to understand the appropriate way to build a strategic and tactical retirement plan that can address your income. It can address your growth and make sure that those risk elements are aligned with your risk tolerance. And then we need to address longevity and long-term care and legacy. So these shocks in the market, when we start to see these big downward trends, it makes people reevaluate where they are. And sometimes people make even worse decisions because they do it out of fear, or they do it out of regret, or they do it out of greed. And sometimes those major emotions behind these decisions can be impactful in a negative way. Sometimes they can be impactful in a positive way. But what I would urge everybody to do is to pause, to reevaluate and think long and hard about what you're doing, and not make any rash decisions. I have somebody I'm working with who's been a client of mine for many years, and he was just about to put some more annuities in place for him and his wife. In this case, they were looking at some more income and then some long-term care benefits down the road. And during the time that we've been talking about putting these additional plans in place, that market drop happened, and we put some applications in, but just the other day, because of how far the market dropped, he said, "Look, I gotta pause this right now because I've lost so much in my 401k that I want to try to rebound before we put this transfer in place over to the annuities." And I totally understand. I get that, and I think that makes sense in a way. But I have seen this before. I've gone through these market drops and downturns before, and I have had clients end up in even worser scenarios or cases because they waited too long with that same intent that, hey, it's going to come back and I want to recover a little bit before we move the money, and then it just gets worse. As a matter of fact, I had this happen back in 22, just 3 years ago, with a dentist. He had just sold his practice, and he got a handsome sum of money for the sale of that practice, and he was going to look into buying some income annuities for him and his wife. And this was actually, no, it wasn't 22. This was actually 2020. So this was like January of 2020, right before COVID happened. And then in March, he wanted to wait. He said, "Hey, yeah, we want to get this planning started, but we're going to wait a little while before we fund and put everything in place." And then before you know it, March happened, and his account went down like 30% overnight because he was invested very aggressively in stocks. And so, long story short, what did he do? Out of fear, he cashed out at the low point of the market, like literally March 17th or something. I don't remember the exact date of the lowest point, but it was right around there. And then he went to cash, and he didn't know this, but literally like within 100 days later, the markets came back and recovered. But he lost out on that too, that momentum, because he was fearful to get back in. Then guess what happened? He went, I talked to him again like a year later, and he was finally getting back into the stock market, and it was too late. And that was when that huge market eruption happened, where everything came back, and then it soared through the roof because of all the money that was being printed that ended up being back in the stock market. So he missed out on the recovery, and he missed out on all of the growth, and he was stuck with still 30% less in his portfolio a year later because he was reactive and not proactive.
Yeah. And that just speaks to the person who's trying to time the market. There's never an exact science. And the thing I always say is your crystal ball is as good as mine.
Yep.
They don't work very well.
Nobody can predict the markets. I don't care who you are. You can be the best advisor in the world, and they will tell you that they don't know what the market's going to do tomorrow. So that's where that planning comes into play. We have to have a plan for the rainy day. Even if those rainy day chances are very slim, it's better to have a plan than not to have one, right? So, you look at these recent events in the last few weeks, $4 trillion lost in the markets. And these are people that are dependent on that money to generate their income in retirement and serve all of the other goals and objectives they have. You go back to March 2020 and the COVID crash, and the market dropped more than 30% in just a few weeks then. And, looking back over the previous black swan events, you have the dot-com bubble, right, Zach, in 2000.
Yeah. I mean, if you look at that, that's what, 7 years it took for the market to recover there. Then moving forward, go to 2008. We were all a little bit too well aware of what happened in 2008. And then you're looking at another 6 to 7 years to get back to that pre-crash level. That's a long time, especially, when we put in that window of what that retirement time frame looks like. Is that 2 years? Is it 6 or 7 or 8 years that we start planning for it? Let's not forget just the emotional roller coaster that we go through, whether that's fear, greed, regret or desperation, like what you had mentioned. And that affects not just, Mr. Jones, but also affects Miss Jones, and what's the planning for the two of them. So those emotions, like you had mentioned in that client scenario, often lead to poor financial decisions, just because we were acting on raw emotion.
Yeah, and that's the biggest thing is we don't want just emotion to be the driver. We want the decision to be one full of confidence, right? The one that you're doing what you're doing and you're telling your money what to do, not your money telling you what to do. Like that's the biggest difference in being proactive and reactive is if you're proactive, you're telling your money what you want it to do for you. And when I say that, I mean formulating a plan, putting an income plan in place, putting a growth plan in place, putting a legacy plan, long-term care plan, et cetera, liquidity plan, putting those things in place. And you're telling your money what to do with that planning and being proactive versus reactive, where you go down these the drops in the roller coaster being the market, right? And now your money's telling you what to do through those emotions: fear, greed, regret, and desperation. Nobody should be making decisions in that capacity when they're faced with those emotions. But sometimes you have no other choice. You have to. It's better to do something than to do nothing at times. So the good news here is that there is a way to protect your savings from market crashes while still having the opportunity for growth. And that's exactly what we're going to talk about today. And that is how annuities, specifically fixed indexed annuities, can safeguard your retirement from market downturns.
Yeah, and I know we've gone over fixed index annuities before, but just because we're considering this time that we're in right now, I do think it's important that we define exactly what a fixed index annuity is for somebody who's catching up now and maybe hasn't seen a prior podcast. So, fixed index annuity is a financial tool designed to give you the best of both worlds, and that's the protection from the market downturn, while still allowing you that growth of your money based on the performance of a specified index or multiple index options, whether that's something like the S&P or NASDAQ or Russell.
Yeah, that's exactly right. And the key difference between fixed indexed annuities and traditional stock market investments is that a fixed indexed annuity comes with a principal guarantee, a contractual guaranteed floor of 0%, meaning that even in these events of market crashes, you'll never lose a dime. So I think we said it on the previous episode, it's a sleep at night annuity. It allows someone to have the assurance that no matter what happens with all of the uncontrollables of the market, your principal is contractually protected and you're never going to lose a penny due to things that we can't control. So in the years when the market's doing well, though, you can participate in some of those gains, either with a cap or a participation rate strategy, but never risk any of that downside loss. So a lot of benefits there to keep someone with peace of mind, confidence, and clarity as they move through the pivotal years of retirement. And that's usually the few years leading up to it, few years after, are what we refer to as that retirement red zone.
Yeah. And that's exactly where the fixed index annuity is valuable, is that during uncertain times like right now, like what we're seeing, while traditional investments will ride those market waves, and a fixed index annuity is going to provide the stability and that protection that's essential for anyone and everyone approaching retirement.
Yeah, and I think that it's important to be fully transparent here and letting everyone know that's listening out there that you should never be considering putting all of your assets into a vehicle like a fixed indexed annuity. It should be just enough to give you the peace of mind and confidence that you're risking off enough of your assets to still serve as a way to grow that money safely, but do so without taking unnecessary risks. So think of it like a bond position. Like when you look at traditional retirement portfolios, um, typically they're going to be an allocation blend of 60% stocks, 40% bonds, or sometimes you'll see a 50-50 mix or a 40-60 mix. And when you look at that, the point of those allocations is to be balanced. And when you look at bonds, bonds were instilled or implemented into that type of plan to perform when equities were down, so that half of your portfolio at all times was still able to do something in regards to a return. But what we've seen in these low interest rate environments over the past handful of years, and the volatility associated with bonds and interest rate environments, bonds can also lose value. So the traditional 50-50 portfolio that people would use or be their go-to in retirement, those can also cause a lot of stress and can also be very risky, even though you're in a balanced asset allocation. And we saw that just in 2022 when equities and bonds were both down and a lot of people's portfolios were significantly in the red. So when you think about positioning the fixed indexed annuity into your overall retirement plan, you really want to think about that FIA as a bond alternative, which we've discussed in previous episodes. You should be positioning that over there to act as a bond, but in the sense that you're shielding yourself from any downside risk that would be associated with a bond portfolio. But you're also in good years giving yourself very fair rates of return, so that in the event you need income or need something down the road, you have this reserve bank that's been growing in that fixed indexed annuity that you can tap into, and you're never being forced to sell shares of a stock in a down market. So that's where that optimization comes in.
Yeah, it would be interesting to see. If somebody speaks to their advisor now, it's funny enough, I've got a call with my advisor tomorrow just to see what their opinion is now on the bond position today compared to maybe what their opinion was 10 years ago.
Yeah, and I think it's probably changed in a positive way, just because interest rates have gone up, which makes the coupon or the yield on that bond attractive. But regardless, there are alternatives to that. Not everybody wants to play that game. And that's where this fixed indexed annuity can be an optimal solution for somebody looking for alternatives. So let's talk about, the general risks, right, of relying on traditional investments. And the big problem here are these recent market crashes and how they can potentially derail your retirement. I've had people in these scenarios, like I said, I've been through these before, and I've had people where they literally have come to tears because they're being forced with options that they never envisioned when it comes to retirement. They're being forced to either work longer to hopefully get that time back on their side to recover, or they're being forced to retire with less money, which then translates to less income, which then also translates to a lesser lifestyle, maybe one that's less than what they're accustomed to and what they've worked hard to hopefully build and be able to create all those working years. And so when you look at traditional investments like stocks, bonds, even mutual funds, you're still exposing yourself to major risks, especially when it comes to these cyclical bear markets that we might be entering once again. So if you think about, where a fixed indexed annuity can help in these scenarios and help against these market downturns, it's very simple. Let's say that you take a fixed indexed annuity, right, and we're linking it to the S&P 500, the pure S&P 500. It's an index that everybody knows. It's one that's easily available to track. Inside of a fixed indexed annuity that's using an S&P 500 index strategy, oftentimes you're going to see those associated with what's called a cap rate. And that cap rate is very simple. It's the ceiling or the max that you can earn each crediting period. In this case, it's every year. The most you can earn would be that up to that cap rate. So if you have a indexed annuity with an S&P 500 with a 10% cap, if the market goes up 8%, you're going to get the full 8%. If the S&P goes up 12%, you're going to get the cap, which is 10%. But if the market goes down 20%, guess what? You lose nothing. And that's really the beauty of it. That's where understanding the mechanics and how to appropriately apply it to your plan is essential.
Yeah, I mean, I've got to speak from firsthand experience. This is my conservative or bond position, if you were to call it that. That's how I use a fixed index annuity personally. This is my bucket for safe market growth. Not concerned about the market. I mean, don't get me wrong. There's monies that I do have that are in the market, but I'm not concerned about my fixed index annuity today with what we're experiencing.
Yeah, exactly. And that's the whole point, is to not have to worry about that portion of money that's in that type of vehicle because of those contractual guarantees. And, when you really think about it too, like we work with a lot of conservative investors. I mean, literally people that don't want any piece of the stock market, either because they just are risk adverse or they've been burned in the past. I've had people tell me, like, I'm the worst stock market investor of all time. Like, no matter what I touch, no matter what I buy or invest in, it never makes a dime. It just goes down. And so there's timing, right? There's always going to be timing risk that's associated with investments. And what we do know is that over long periods of time, the stock market goes up. And if you look at since the inception of the S&P 500, which was 1957, if you were to break out all of those years of returns, it's about 75% of the time, the S&P is up on an annual basis. But you still have that 25% of the time when it's been down. And so if you time it wrong and you're not really spending enough time in to recover, or you're putting your monies in at the peak and then pulling out at the bottom, obviously you're not going to have a great day or experience investing in the market. But it's important to understand that, it's okay if you don't want to invest in the stock market. We work with people that are conservative, very, very conservative, where, they've still amassed a very fair amount of wealth. Because generally what comes with very conservative people is they're also great savers and they're not big spenders. And because they avoid losses, they also don't lose time, trying to recover. And what we often find is that slow and steady sometimes wins the race. And it's like the old story of what was it? The rabbit and the hare and the tortoise, right?
Yep.
The rabbit, is that it? Yeah. The hare and the tortoise.
Yeah.
And, slow and steady wins the race. And what I can tell you is that when these conservative investors find out about fixed indexed annuities and how they can still participate in these market upside, the upside growth of the markets, but not have to worry about experiencing any of the losses, it becomes a very attractive product for them because, they're used to getting very menial or lower rates of return in these very safe money investments like CDs. They might be getting 4 or 5% on a CD in today's market. But when they find that they can get a better return above and beyond that CD type return, and I'm not talking about huge differences, but if you can get 6 to 8% in an indexed annuity versus 4 to 5% in a CD, that extra 2 percentage points really adds up over a long period of time. But when they learn about these products, and I think that's key, is that education around these products is so essential to really, letting the masses know about these products, because they really can serve a large group of people that have interest in what these indexed annuities have to offer. When you're looking at annuities like fixed indexed annuities, there are actually 2 different ways that they can protect you during a market crash. So we talked about the protected accumulation option, which is just having a guarantee contractually of principal protection. There's a 0% floor, or in other words, there's no downside risk. If the index that you're allocated to happens to go down at any point in time, the worst you can ever do is a 0 in that crediting period. You can't incur any losses or negative aspects. But the other way is obviously guaranteed lifetime income riders, which we've talked about on previous episodes. And those guaranteed lifetime income riders are surefire ways to help people during these market downturns because of the guaranteed income that they provide. And they allow someone to afford the wherewithal to ride out these roller coaster waves or these swings in the market. Because of that lifetime income that's being created, it can help someone look at the rest of their assets that might still be invested in the stock market with a completely different lens, because they're no longer dependent on that stock market portfolio to provide income. And when you can create that independency from the markets, and you can allow that income to be completely separate from what the markets are doing and all of the unnecessary uncontrollables, it really gives someone a ticket for peace of mind, right? A way to just kick back and relax and know that regardless of what happens, their income is protected and it's coming in every month. And guess what? If you go back during every major downturn in the markets, they always come back. It's just a matter of time and how much time it takes to get back. But when you have income completely separate from those market accounts, that allows you and affords you that bounce back time, which is essential to ultimately growing your portfolio long term. You have to let it come back. If you make bad decisions trying to get in and get out because you're fearful of losing, that's when people get hurt.
Yeah, and you hit on a great point in understanding that there's two different ways that these fixed index annuities can help somebody, and it's not a one size fits all. So these can be used in multiple ways, and we can custom tailor that to somebody's needs. And I just think that oftentimes in some of the conversations that I've had, somebody may be approaching this in a straight line, soldiers marching, and this is the one priority that we're looking for. But once we dive deeper into the understanding of what the plan is, we can use an annuity in more ways than one with different annuity types.
Oh, 100%. I mean, that's the right approach, is to look at, really the goals and objectives for the money and for that individual, what they want that money to do, and then fit the right type of annuity with the right type of planning or contractual guarantee to help meet that objective. And that's so important to this decision is, if you have a need for income, we're looking at guaranteed income. If you have a need for safe growth, well, we're looking at either fixed rate annuities, the MIGA, or we're looking at fixed indexed annuities for protected accumulation. If we're looking at long-term care, there are annuities that offer guaranteed benefits for long-term care. So it just comes down to really understanding the objective, and that's important to any decision and any plan, is coming up with the goals and objectives, and then what assets do we have to fund those goals. And that's where we really enjoy what we do, is because one of the things that we're passionate about the most is bringing transparency to this very complex world of annuities. And it doesn't have to be complex. I think there's a lot of misinformation out there. There's a lot of bias out there in our industry. And I will tell you right now, anybody that doesn't like annuities, you have to really be questioning what their real intentions are. Because if you explore annuities and you break them down around the contract and what the contractual guarantees are and how they can be used, and there's softwares, if we work with you, we can model out anything to prove that factually, economically, the annuity in your plan gives you better outcomes than not having one. And it can optimize the growth part of your portfolio, which people don't understand.
Yeah,
So,
and I think there's an example. You've got an example ready for us to take a look at of that, right?
yeah, I have a little chart here that I was planning to share, just
Yeah,
to
and
kind of bring some more understanding and clarity to it with a visual.
if I can add, when we talk about the contractual guarantees that come with these, what do we have from the advisor that we work with, or what do we have from the market? There's no guarantee. There's nothing that's in place to secure our future other than what we're at risk of. So understanding how this tool can be used and the contractual guarantees that you have with this and the value behind it is important.
Yeah, 100%. And I think the appropriate application of the annuity, it has to be understood what role it's playing. Like, what is it actually doing, and what goals and objectives is it helping address and serve? And in this case, when we're looking at a protected accumulation fixed indexed annuity, it's obviously a growth play. It's all obviously a de-risking tool. So we're de-risking a portion of the portfolio, but we're still giving it very fair rates of return opportunity. And that's the one thing that really drives me, I guess, crazy at times when I speak to people, prospective clients, and that is, I believe they have unrealistic expectations of like what the markets actually do. And it's because of the recency bias with this huge overinflated stock market that is just ridiculous, honestly. And it's just bound to pop, right? It's just bound to burst at some point. It can't be sustained long term because the overall economics, if you look at the rest of the economic indicators of the health of our country, they're not that great. We're seeing debt at all-time highs. We're seeing delinquency on credit cards and mortgages and auto loans peaking right now. They're at a 10-year high right now. And so if that was true, then why would there, the stock market that's supposed to be another very big indicator of the health of the U.S. economy, which it is, and it should be treated as such. I just think that what we're seeing is false. The numbers are false. And the reason is because of all the money that was printed in 2020 and 2021 due to the COVID crisis. More money was printed in that period of time than all of the years past before it. More money was printed during COVID than all the money that's ever been printed in previous history before that. And so where does that money end up? Well, that money becomes spending money for consumers. And so they start buying toys. They start buying, secondary real estate, rental properties. They start buying goods at the store that they don't necessarily need. It's consumer discretions, right? They're just buying whatever they can. And then ultimately what happens is that affects the bottom line of these larger corporations. And then they report their earnings. And then people have money on the sidelines because of that money as well that's been sitting there that they've been waiting to spend. And then they invest it in the stock market. So we have this very hyperinflated stock market. And in my opinion, right now, it's a very false indicator of like what actually is going on. And if you look at it, the fact that the stock market just in the last 2 years, the S&P 500 is up 50%. But what you don't understand is that that's recent. That doesn't mean that's what it's going to do every year. It's not going to provide a 25% annual return. Since inception, 1957, the average return of the S&P 500 is just over 7%. That's it. And while there are very big years, there's also very big drops. And I think that's really the key to understand is that if you can take a portfolio and rid it of those big losses and just get a healthy average return over time, but rid it of those losses, the average return and the total balance can be very, very handsome at the end of that race. And the key is mitigating that 24% decline when the markets are down 24% of the time. If you can avoid those, you can have peace of mind while also having a very handsome balance at the end of that journey. And that's where I want to really share this chart with you, just to give an example of what this would possibly look like if you were to have something like this in your portfolio. Did you want to add anything there, Zach, before I shared my screen?
No, let's share that. I'd like to speak to what you've got here.
Okay. So share.
This is where if you are listening to the podcast and only listening to it, if you've got the ability to pull up the video and see it, it's really valuable information. And if you're a conservative investor like I am, admittedly, you're going to love this. And if you don't, you must not be seeing it the way we are.
Can you see my screen, Zach?
Yeah, we're good.
All right. So what this is a chart or a graph that's modeling out the traditional S&P 500. So these are the real returns annualized over a long period of time from 1998 to 2024. So just to last year. And the point of this chart is to show the real returns of the S&P 500 modeled alongside a fixed indexed annuity that was linked to the S&P 500, but had a 10% cap rate. So every year, the most it could earn each year was 10%. And so I've mentioned it on previous episodes. When you look at a fixed indexed annuity on a graph, it kind of looks like stair steps in a way, because you don't have any losses due to the contractual guarantees of principal protection. So in any negative years, you just earn a zero. So it's just a flat year, okay, on a graph like this. And so the green line is representing the fixed indexed annuity with the 10% cap on the S&P 500. And the red line is the pure S&P 500, the real returns. And there's a couple other colored lines on here. There's a blue line, which is just a 4% fixed rate guaranteed each year. And then the yellow lines is representing what's called a minimum guaranteed surrender value, which is commonly associated with an annuity. But in this example, it doesn't really have any relevance. So when we're looking at this chart, right, from 1998 to 2024, what's interesting is you'll notice in the earlier part of the graph from 99, which was the peak of the S&P 500. And by the way, these balances, it's starting with $100,000. So $100,000 going into the S&P 500, 100,000 going into the fixed indexed annuity with the 10% cap. But what's interesting is if you go to the 1999 line there, you'll see that was the peak, the initial peak on this graph for the S&P 500. So, but what happened shortly thereafter was what we call the dot-com bubble. It burst. So the tech stocks all plummeted, and over, I think it was like 50% was lost. 50% lost on the NASDAQ during that time, from 2000, 2001, and 2002. So you see the big drop. Do you see that, Zach, where the line just goes straight down almost? And then when you look at the indexed annuity, during those 3 years, it just went straight across. It just went flat because of that contractually guaranteed 0% floor. No losses can be incurred there. Going to 2002, you'll see that's when the S&P started to recover, or not the this S&P started to recover there. And then you'll see the green line obviously going up. Well, if you look at this and how many years it took for the pure S&P to get back to even, it took an astonishingly long time. We're looking at 7 years. While the slow and steady green line with the indexed annuity with the 10% cap rate just steadily climbing. And you'll notice at that 2007 year when the S&P basically just got back to even, you'll notice the balance. Remember, it started with 100K. In 1999, at the peak of the S&P, it went up to 119,526. And then all the way back in 2000, fast forward to 2007, it got up to 119,454. So basically back to even. Well, guess where the indexed annuity is? It's at 154,698. So a significant difference because of that guaranteed floor, principal protection, and the fact that we're mitigating that loss. We're avoiding or ridding ourselves of those drops in the market. So long story short, over the next, from here on another 16 years, while the S&P continued to climb and ebb and flow, you'll notice that in 2007 and 8, that big drop happened. But then fast forward out all the way to now, 2024, And this chart ends with the indexed annuity actually being higher, the ending value, higher than the S&P 500, even with these recent years of 25% returns. The ending balance over this period of time is on the indexed annuity, it's 483,456, and the S&P 500 is at 478,481. And the real point of the story here is if you can mitigate the losses and get those out of the portfolio, the balance and the growth potential is unmatched. It's just about getting rid of the losses, the 25% of the time when the markets are down. And if you can get a fair rate of return still, your ending balance is going to be very handsome. And guess what? All during that time, you've had peace of mind. You didn't have to worry when all your friends are, panicking and talking about what they're going to do without all this money that they just lost. You can sit back and say, look, there's better ways. And that's really the point of this episode, is to educate people that there are better ways. We don't have to do what we've always done. And I think that the markets are important. I'm not saying nobody should be in the markets. I am a believer in the stock market, but I think you need to appropriately apply the right tools during the different phases of your life. The stock market's great for your accumulation phase of your life when you're working. It's also great in retirement to be your growth bucket, your growth vehicle. But you have to de-risk a part of your portfolio in order to give you the peace of mind and mitigate the unknowns and the potential risks that we face with all the uncontrollables of these stock market events.
Yeah, I think this is a great tool to see the short term, that being the most recent 4 years. I think that's the greatest point of reference here. But obviously the long term, going back to what was that, 98, seeing the effect. But I love the most recent 4 years and what that shows us, and that big drop that we saw in the market, and what that annuity was able to do with that cap. And that's just staying level. Meanwhile, if we look at 23 and what happened here, you see that cap, that 10% cap, is actually above the S&P in its performance. And maybe it's just pure irony, but that cap of that 10% is in green, and maybe that's the tortoise outperforming the S&P. But
yeah, I didn't even connect that, but yeah, that's true. The green,
pretty coincidental.
Yeah. What's interesting to note, if you look at that global financial crisis period from 07 to 08 and part of 09 there, look at the gap between the green and the red line. Like it's amazing. And then that gap, that spread, was like a huge difference for the next 10, 11 years. The green line is just so much higher. And then these recent, like huge, last couple years in the S&P with these 23, 24% returns obviously shot it back up, and it did make up some ground. But the point is that you shouldn't expect those types of returns every year. It's unrealistic. And the only reason those big returns happen like that is usually they're following a huge loss. And that's always indicative of this on this graph. Look at that. This was 21 to 22. That was that really bad year when both, stocks and bonds got slaughtered. And then what happened? They had 23, 24% returns back to back because we followed a huge downturn. Same thing here with 2017 to 2018. That was another bad year. And then it shot up. And so what always follows those big drops in the market are usually decent returns or very above average returns. But point being is that those aren't really real, because there is a time frame where you have to get back to even before it's considered gains. And the S&P 500, the indexed annuity with the S&P 500 with a cap, you're avoiding all those losses and you're getting fair returns up to that 10% cap each year. But the slow and steady, in this case, wins the race.
Yep.
Now for the naysayers out there, because I'm sure we're going to get some comments of, maybe it's people that are against annuities, or they think that they're all hype. I watch all the videos out there. I know there's a bunch of people that hate on annuities, and that's okay. It just means that they're not educated. And the fact that they're willing to admit that is crazy, but neither here nor there. The point of this is to address what people are going to say. First and foremost, to be fully transparent, the indexed annuity was created in 1995, but it didn't have this type of cap. It wouldn't have had this type of cap rate during that time. It wouldn't have had a 10% cap, but it's not because it didn't exist or it couldn't exist. It's because that product was new. And these insurance companies and investment banks that help create these products, along with these crediting strategies and these actuaries that build the products, they didn't know what they didn't know, right? It's anytime something's new, it's like a trial and error. You put it out there, you see what works. And sometimes it takes time for these things to iron out and actually be a solid product. So I'm not saying indexed annuities have always been great. And back then in 95, they probably weren't. I wasn't around in the industry then, obviously. But what I can tell you is that these cap rate strategies exist today. And within the last year, I've seen them as high as 12.5% on the cap. So that's above and beyond this 10% example. So for all the naysayers out there, we already know there wasn't a 10% capped product back then, but there is one today. And one thing that we can do is help you sift and sort and compare all of the annuities on the market. If you're interested in a strategy like this, we're going to find you the best product out there with the S&P 500 with the highest cap we can find. And as an independent annuity advisory firm, we work with every major insurance company. We'll find it. We'll find the best deal. And we're not just going to look at one. We'll compare 2 or 3 side by side and show you all of the features and benefits that you might be considering in each of those products and help you make a well-rounded, educated decision.
Yeah, and to bring this back around, the reason that was presented as a tool and as a reference is just going back again to that main point of, do you have 5 years to recover a big loss like that? Do we have the ability to endure that? So that's really what we're trying to drive home here. How a fixed index annuity can be valuable for somebody looking at retirement in the next 1 to 8 years.
Yeah, and that's really our mission, is to help bring these other alternatives, these other ideas, these other strategies and products that can help fulfill the goals and objectives and needs that you have, and that there are other ways that could be better for some out there. And I think it's just a matter of understanding that we're all accustomed to the stock market. It's kind of how we were raised, if you will, being a citizen of the United States, a capitalistic society, and Wall Street's done a banner job at teaching us that, hey, if you want to be wealthy and you want to grow your money, you need to invest in the stock market. And it's kind of what's just been spoon fed to us over our entire life. It becomes habitual. It becomes a habit, right? That's all we know. That's all we do. And we become accustomed to it. But there are other ways to grow your money. There are other ways to de-risk your portfolio, and do so in a very strategic way, but also ways that can earn a fair rate of return without taking unnecessary risk to get it. So that's the point of this. We're very passionate about what we do here. We're really trying to bring more transparency to the annuity industry. These are great financial tools. They are often misrepresented. They are often mispositioned or inappropriately applied to someone's plan. And I also will tell you that most of the time annuities are sold, they're not bought. And that's really what we're trying to change, is to right the wrongs of this industry, bring the transparency to people that need it and want it and can use it, and ultimately help lift people's annuity IQ to a higher level to help them make informed, educated, and confident decisions. And that's really what we're on a mission to do. So with that being said, I think it's time for us to close out. Zach, did I miss anything there?
No, and just to put a bow on it. So as a reminder, fixed index annuities are there to protect you in two ways, right? So we've got guaranteed lifetime income and protected accumulation. So you're not incurring that downside market loss. You can safeguard your retirement while still allowing for upside potential. So there's the value in those two annuity types. And keep in mind that they can be used in different ways and in different positions. And again, it's not the end all be all answer for every client. It's also not the end all be all answer for your entire portfolio. We don't see it as that. It's a piece of it. So if you do want to learn more about how annuities can fit into your retirement plan, check out the link below. There will be a link that will allow you to book a meeting with us or just get your free report. So you can get a report directly from us. No conversation, no cost. And then if you find value in that report that you get from us, then from there, what we can do is speak with you if you're interested. So don't wait until the next market crash. Today's the day to protect your future.
I love it. Yeah. Thank you for sharing that, Zach, and appreciate everybody tuning in. When Zach and I first started talking about doing this podcast, we really didn't know exactly what we were going to talk about or how it was going to really play out. But one thing I can tell you is that the passion is what's driving the message. And it's the way that we feel about helping people, right? That's the biggest thing that Zach and I have in common, is that we really enjoy helping people, and we really enjoy helping people make good decisions. And we really appreciate everybody tuning in. We're very humble. We're getting a ton of positive feedback on the content that we've put out so far, and we're just truly honored and blessed to have the opportunity in this platform to share our message and our passion to the masses. So thanks for tuning in. If you're getting value, like and subscribe. Share this with a friend or family member that might get some value out of it too, and we hope that we can help bring some value to them and their understanding of annuities. But thanks so much for watching. This is Jeremiah Conger and Zachary Van Ness. Who are we, Zach?
The Annuity Dudes. I forgot it last time.
The Annuity Dudes signing off. Have a great day.